Now in today's video we're going to be looking at borrowing a medium amount of money. So not a home loan, that's a large amount of money. Not just a little bit of money you might put on your credit card, but a personal loan. So this would be things like, quite an expensive holiday or a car, or, buying something in the order of, several $1,000s. All right, so the key thing is that there are conditions, and it's a loan. You have to pay back a set amount every month, every period. So here's a sort of advert you might see: 8.99% per annum for a newish or new car. All right, so car loans are generally secured by the actual car themselves. There'll be, if you didn't pay the loan off, they could get the car and sell the car. A little bit what they would do with a home. If you don't pay your repayments on a home loan, they close your account and then they sell your house. All right. So the deposit, many dealers will insist on the deposit being paid, and that shows that you've got some money behind you to secure the purchase of the vehicle, and that's normally around the 10% mark. All right. And obviously, if you've got a trade-in, then that could be used to help secure some finances there. So you've got to be careful when trading in a car, because car dealers, they don't really give you very much for that. So you're probably better trying to sell something like that online using car sales or Gumtree or something like that. All right, so that's probably a better way to do that. Because you might get, say, $3,000 on privately, but the dealers might only give you $1,500. That's what they sort of bank on. So this example here says, calculate the cost of car loan required to purchase a new Toyota Prius worth $36,550 if a 10% deposit is required, and the car dealer offers you a $4,600 trade-in on the old VN Commodore. Alright, so the cost of the car is that. Put that in there. 10% deposit is meaning that you have to take away $3,655, less your trade-in $4,600. So the balance that you would have to get your loan on is $28,295. So when you go to the car dealer or car place to buy that car, they'll offer you finance. They have finance companies that will offer you, and sometimes those finance companies will offer you a pretty good deal. Often though, you're better going to a bank prior to that and organising a personal loan. Alright, so again, it's about going to your bank first and then understanding how much it's going to cost you each month, and then seeing what the car dealers can do there for that. Alright, the car loans, so we do know cars are expensive, and then obviously, for most people, they can't just go and spend $30,000 on a car. So that's why we generally loan money for that. So the cars, as a newish or new car, that would be something we'd classify as less than 5 years old. And then what you have to do is basically show that you can prove that you can pay back the loan. So generally loans are over 3, 5 or 7 years. And that obviously depends on the value of the car and your ability to pay back the loan. So you can actually have the loan taken out of your pay as a direct debit, and that's great because then you don't have to think about how I've got to pay my car loan. All right, it just comes out of your pay, which is a really good way of doing it. Alright, so what's the monthly repayments? Well, we have to use our calculator to work out our monthly repayments. Now you could do this on your graphics calculator, or you could use the formula which we've seen a number of times. So it's saying you have to pay back $587.36 per month. Alright, so that's that example there. Alright, so going through these questions, under what conditions are most people getting a car loan? Well, the car is newish when it's less than 5 years old. So a lot of people buy a car and they'll buy an older car which is only worth up to $5,000. A lot of people then are paying cash. So you can prove that you've got enough money to actually pay back the loan, and you'll better get a loan. All right. How long does a car loans normally go for? Well, 3 to 7 years. Suggest 2 reasons why car loans may go longer. Well, obviously, if you've got a very expensive car worth hundreds of thousands of dollars, then, you know, that might take long to pay off, or obviously, depending on your ability to pay it back, you might take it over a longer period of time. Now, to calculate your monthly repayments on a new car with $21,900, 10% deposit with trade-in of $6,200, and it's over 3 years with 9.5% interest. So the car costs $21,900. Less the deposit, less the trade-in means that you have a loan for $13,510. Putting it into the formula works out that your monthly repayments need to be $432.77 per month, right? Or working that out, that works out to be $99.87 per week. All right. There is another way of getting a car, and you can actually lease a car. All right, you can actually lease a car from your personal car, and what you do is you set that up to be doing that out of your salary. So you're paying it pre-tax dollars, so you're paying it before you pay tax on your money. What that does, it reduces the amount of tax that you pay. The benefits of that is most of the stuff that you buy for your car, you're not paying GST on. All right, and then the other benefit of leasing a car, it's called a Nova to lease, is that you get your car, possibly a brand new car, much cheaper. All right, so you're not paying the GST on that, so that's 10%. And then you're also generally buying from a dealer where you're getting fleet discount. So let's say you got a $50,000 car you want to buy. Through your fleet discount, you might get that down to 47, or around that sort of mark. So you get about $3,000 discount, and then you get your GST free on that purchase price. So that's another $4,700 worth of savings. All right. So if you are looking at a new car, that's sometimes a really good way of getting that.